from IBBI. Mr. Dev Jyoti Chaudhary is also there. Our chairman has not been able to connect, so we may start with this. Good afternoon, as per Indian Standard Time, all of you. And this is a pleasant moment for me when IVSC has joined hands with the IOV Registered Value Foundation to organize this webinar. And the subject we have taken is rightly apt in the situations what at present the valuations scenario going on in India. That is the development in valuation as profession with a global perspective. Nick, I think we would like to have a view of yours in a global perspective. Nick has been traveling throughout all the countries, organizing number of seminars and taking all nations along with him in his pursuit of valuation standards, which they are coming up and spreading is his main target. Sudhak, welcome, sir. Welcome, our chairman, Dr. Gautam Sen Gupta. Let me introduce. He's at present Vice Chancellor of Techno India, Kolkata. So he let him take over now. Sir, welcome. Yeah. Good afternoon. So I just started because you were not able to connect. So please say something.
Yeah. Good afternoon. Am I audible?
Yeah. Yes, sir. Perfectly.
Okay. Good afternoon. It gives me immense pleasure to address in this August gathering on this extremely important webinar on development in valuation profession, a global perspective. I heartily welcome the chief guest, Sri Sudhakar Shukla, WTM, Registration and Monitoring Wing,
Thank you.
IBBI, and today's speakers from IVSC, Mr. Nick Talbot, CEO, and Mr. Alexander Aronsohn, Technical Director, Tangible Assets of IVSC. Let me also share that my university, Techno India University, of which I am the current Vice Chancellor, is the university in India having an academic member of IVSC. Valuation, according to me, is a crucial component of the financial system which directly or indirectly affects everyone, be it a corporate or an organization or the society. Valuation thus touches almost all parts of our national and global financial system. Hence, professional judgment of valuer is essential in the subject of valuation. Therefore, valuers need to be exposed to new technological innovations on one hand and international standards on the other hand to pursue a sustainable profession in the new emerging global order. COVID-19 in its past era and what is happening today all over the world shall affect all processes in which the businesses are run today, and the researches conducted by our university in its COVID-19 Center for Research suggests that dramatic changes and consolidations it shall bring in the field of valuation as well. What technology-driven changes could happen over the short to medium term in the field of valuation? That's the question. How will technology advances impact risk assessment and risk mitigation? Will predictive analytics shift the valuation problem from what is the value to what will be the value in future? How to unlock the real value? These are just some of the questions that the valuation industry needs to focus and address. Enhanced automation in valuation, big data and artificial intelligence are technological innovations that are shifting the construction and real estate appraisal landscape. Valuation professionals are unsure how near or far these technological innovations is, and how these are shifting the construction and real estate science, and how this will impact the professional practices. The confluence of regulatory transparency, technological advancements, and the market demands for speed and driving changes faster than ever before are some of the key issues. Consumers of valuation solutions, that is the investors, lenders, rating agencies, etc., who are processing volumes of valuations, will have new risk assessment models created by big data aggregation and models propelling by artificial intelligences. The suite of technological innovations that will converge on the valuation industry in the term will therefore become most crucial for the future. We are already seeing drones that inspect property, smartphones that replace laptops and desktops as workplace production tools, and automated valuation models, which we call AVMS, that process all the data that gets collected via algorithms and machine learnings. The world's economy has benefited from the growth of international standards on a number of fronts, including financial regulation, accounting, and auditing standards. Valuation standards have a significant role to play in helping to regulate professional practice in national, regional, and global levels, promote professional ethics, integrity, impartiality, and trust in valuer activities. Many government and professional bodies are responding to international pressure to regulate the valuation profession by reviewing the regulatory environment, valuers training, and compliance with standards. In an increasingly global environment, it is necessary that standards, international valuation standards, are central to valuation practice and bring many benefits to property markets in terms of economic competitiveness, promoting excellence within the valuation profession, and ensuring transparency across markets. India shall be one of the fastest growing economies in the world and has the third largest spending power, and therefore has a strong interest in a high quality approach to valuation both nationally and internationally. With increasing competition between countries to attract domestic and international investment, it is right that the Indian government has taken steps to improve the professionalism and transparency in the field of valuation. The traditional approaches to valuation need to be carefully reconsidered on the emerging environment with regard to technological innovations and adoption of global standards. With these words, on behalf of IOVRVF, I have the pleasure to heartily welcome everybody attending this webinar and look forward to witness extremely lively and informative sessions from our learned panelists who are names to reckon with in global valuation field. I close my speech by welcoming you once again to this webinar. Thank you very much.
Thank you.
Thank you, Dr. Sir.
Thank you.
I request Dr. Sudhakar Shukla to give his views on the inaugural part of it. Thank you.
Thank you. Respected Dr. Gautam Sen Gupta ji, international experts, Mr. Nick and Mr. Alexander, Dr. Goyal and colleagues. It is my proud privilege to be part of this illustrious gathering of eminent persons. I will take this opportunity to share some thoughts on concepts called value, and also briefly touching upon contours of proposed edifice concerning valuation profession in India. Dr. Sen Gupta has already given a strong opening remarks regarding use of technology. And use of technology is of paramount importance because over a period of time, one thing is sure that wherever you are making assessment of value, you cannot shun away the subjectivity altogether. And that is why it is very necessary to understand the concept of value itself before coming to valuation part. The value, if you see from definitional perspective, there are so many schools of thought which bring in their perspective on value. Philosophical opening would be, I quote Brian Dyson, who is the CEO of a famous multinational company. He says, and I quote, value is value only if its values are valued. So if value loses its shine, it is no longer a value for a holder or a user of the particular setting. Economist view is a bit different because we always say that there is a famous water diamond paradox which says water is full of utility, but if you see the price of water, it is zero or close to zero, maybe very marginal these days. But diamond, which does not have that kind of utility for the mankind, but is still priced very high. So what it indicates is the utility is important, but equally important is scarcity. Things which are scarce bring in own value in the market to be dispensed by the market forces. Auditor's view is very clear that you are basically ascertaining a simulation exercise for attempting a value, and basically it's a discounting on the basis of value of depreciation which you assume. So not many assumptions go into discounting factors and depreciations, but real-time impact analysis is very important to go forward. Coming to IBBI, actually, our opening objective is maximization of value. it recognizes value maximization as a reasonable goal, even if CD is in liquidation stage. So what it says is, if it is a going concern, you're coming up with the resolution plan, then of course you need the fair value and the liquidation value. But even if it is at the liquidation stage, you have to try to derive maximum value. So here the onus of the professionals is very important, because they have the decision to take whether it's a valuation of business or assets. It is valuation on the basis of slump sale, partial packages, or you are selling the asset as a whole. So there are so many assumptions going into for realization of maximum value one can achieve. And if you come to the latest edition of the report which we have come out with, and which has started the debate to set the new platform on valuation, the way we look at valuation standards and valuation profession. The book first page, Carl Menger says it is a judgment economizing men make about the importance of the goods at their disposal. So it is again a judgment. It does not say that it's a like foolproof system to get a specific value. It's a judgment. All the time a subjectivity is involved. Therefore, to gauge or quantify the near truth, because we cannot achieve full truth on going concern basis, existence of professionals and their services are of paramount importance. In this context, it is well recognized that professionalization provides the competitive edge, as professions are supposed to perform second-order state functions such as audit, reporting, monitoring, due diligence, and compliance, etc., in a well-structured manner. Moving forward, valuation profession has a long history in India. Actually, first professional valuation society was established in 1968. There have been so many illustrious names who were professing this profession and come out with decent reports. Wanchu committee I have in mind when I say this. Irani committee is there. And MCA also set up many working group of eminent persons to get the right atmosphere, environment to develop this profession in the country. But what we see that despite this long history, what was lacking in overall setting in India was that these institutions which were calling the shots were working in silos. Different statutes, banking, securities, taxation laws, corporate laws, and IBC required valuation for variety of purposes, and within those purposes, valuation was carried out. So there was no seamless transition for a valuer to go across the field to charter his or maybe to refine his expertise as a valuer to deal with all asset class across the sectors. All efforts confined to the boundaries, as I mentioned. And despite the limitation, the valuation profession has developed as an independent multidisciplinary profession. The company's registered valuers and valuation rules, which currently guide the registered valuers, provide a unified institutional framework for development of regulation of valuation profession in India. Though it was framed under Companies Act, and this is one of the criticism moving forward about the new draft, that whether it would be, its confines would be Companies Act or it will be going across the sectors. So since the regulations I am referring to were framed under Companies Act. But if you see that over a period of time, many banks and even SEBI adopted the same on voluntarily basis. So this is very important that already a regulation which is framed under Companies Act has been voluntarily adopted by different agencies because it is regulated and we know the entity who is doing the valuation and who is responsible to a regulator. As mentioned earlier, value is a context specific. Some assets could be valued by different stakeholders differently. A crude example could be an ancestral property. Elderly owner may attach high emotional value to it. Inheritor may view it as an opportunity to change house and buy other luxuries. Buyer may refer to its depleted stage. Tax authorities may inflate the value for realization of larger wealth tax. An insurer may try to keep the value down depending on the case to avoid any consequent liability. So from which side you're seeing the same house, your valuation would be different for the same property. However, from valuation perspective, whole exercise is simulated estimation. I mentioned this earlier. In process of this simulated exercise, if the market price converges with value, then one can reach a safe conclusion that valuation has been perfect. Under the dispensation of the code, an IP aided by valuer have immense responsibility to reach this perfection in estimation of fair value as well as liquidation value. These serve as reference for evaluation of choices for resolution plan, consequently of stakeholders and also liquidators. Objectives of maximization of valuation under the code are not possible to fructify without near perfect valuation estimation devoid of subjectivity. Not only in the context of the code, international experiences demonstrate that failure to get right valuation at time creates systemic crisis. When I say systemic crisis, I have property crash in UK in 70s in mind. I also have S&L crisis in USA in 80s and 90s, and Schindler affair in Germany in 2005. A few examples how situation go out of hand if valuation is not followed in a due diligent course. Though world over, as the distinguished panelists will also elaborate, the regulatory approach evolved from self-regulation to co-regulations to state regulation. So there is a transition from self-regulation to co-regulation and then the state regulation. However, it is not followed uniformly across the jurisdiction. Actually, even today, more and more emphasis is being placed on prioritizing the self-regulation. And if you come to the draft valuer bill, it is to mention that proposed paradigm provides for a robust system of self-regulation for development of the profession through VPOs and regulation of profession to be carried out by National Institute of Valuers. So this is two-tier system, but self-regulation by VPO is very important milestone which would be contributing immensely in development of the profession. This approach facilitates to retain the benefits of self-regulations while allaying the fear about any possibility of regulatory capture. So this is the point we had in mind when we drafted this new paradigm, and the bill is already under public discussion. The bill, if you see the ecosystem which we have proposed, it has 4 pillars. there is a National Institute of Valuers as regulators. These include Valuation Standard Committee. This is important because right now we don't have any valuation standards. We ask our RVOs to provide the standards, and if they so wish, they can ask international valuation standards to be followed in a particular exercise. So we wanted more clarity to come in on Valuation Standards Committee. Then second pillar of the ecosystem is valuers. And again, there is a debate going on right now because we have given an appropriate level playing field both to individuals and entities alike. Because largely this profession in India has been individual driven. So people are a bit wary that entities and corporate entities would be detrimental to competition and they will wipe them out. But as the Dr. Sen Gupta was mentioning in the opening remarks, that profession has to be on scientific line. If you are talking about AI, you're talking about technology, then investments also have to come into valuation profession to sustain it on scientific lines. Then we have Valuer Institute, and this is basically to ensure the quality of education required under each asset class. And I mentioned earlier also that VPO we have designed as a frontline regulator, and this would be functioning as this would be having a developmental role in moving forward the mandate of the bill. So I think I just introduced what is there in the bill, but there are so many niceties in it. If discussion permits, of some questions are flowing, then we will try to answer them. Thank you very much once again for inviting me to share my thoughts. Thank you.
Thank you, Dr. Sab, for your insights as an authority regarding the values and the present position of the valuation profession in India, and as regarding the valuers bill, which is it is now talk of the town, I would say, in India. You know very well. So now I would request, time is too short. I would request Nick to come in and express his views and his presentation. Please, Nick.
Thank you, Vinay, and thank you, Dr. Shukla, for that insightful overview. And it was also good to hear from Professor Sen Gupta earlier. I'm going to try and share my screen, so hopefully the technology will work, but I'll rely on you, Vinay, to let me know if the technology doesn't work at any particular point. So hopefully now you can see some slides which I will talk you through. The reason behind international standards, or if I think about what the most prolific international standard is in the world, I would argue that it's football. And if you watch the World Cup, or anyone watches the World Cup, then obviously every team goes, they play to the same set of rules. The audience knows what's expected, the customer knows what's expected, they know who wins because it's very clear. And so when I think about the international standard that is accepted in every single country, it's not IFRS, it's not yet IVS, but actually it's football. And I think it's a good example. Imagine if you had 195 different countries turning up to play with different rules, each of them. Then the customer would have no idea what the outcome is. And the same can be said for valuation. Unfortunately for me, I supported a team called Newcastle United, which was never very good. And as a child, I used to sometimes think that it was called Newcastle United 0, because every time I heard it on television or radio, it was always said Newcastle United 0, Manchester United 5, 10, whatever it is. The Indian World Cup is perhaps a more the ICC World Cup is perhaps a better example. That's how we knew at the time that the Indian team was the best in the world. Again, standards and consistency are really important. So who are the IVSC? We're essentially a global body that's responsible for developing and setting international valuation standards. And we do that by bringing experts together from around the world, sit on our boards to talk about, okay, well, these are the issues we see, this is how we think the standards need to be further developed. We put that out for public consultation and we welcome as many views as possible. And we want to take the best ideas from wherever they are in the world. And indeed, we do have a member of IOV that sits on our tangible assets board, by way of an example, Mr. Sandeep Kumar Deb. We also want to promote and grow the valuation profession worldwide. We believe valuation is so fundamentally important that it deserves that international recognition as a profession. We're independent, we're not for profit. We cover all areas of business valuation, tangible assets, financial instruments, anything you can value, our standards cover, but with a principles-based approach. And we accept that different countries have different legislation, and it's often important some countries will adopt international valuation standards and then add an additional chapter in relation to their local law. But what's important if you're an investor, if you're a domestic investor, you want to know that the advisors you're using for valuation are using best practice, ideally international best practice. If you're an international investor, you don't want to have to understand the 195 different approaches to valuation. You just want confidence. And this is a really important point for most countries. If you look at inward investment in China and India, for example, both receive billions in inward investment every year. However, China currently receives far more inward investment. And one of the differences is that they have had a regulated valuation profession for many years there to help give that confidence. And my personal belief is that the step towards a regulated profession in India will hopefully give international investors greater confidence when it comes to making it easier for them to invest in India. And so the role of each and every valuer is really important. We work with IFAC, IFRS, the auditors, IAASB, the World Bank is a member, the UN and IMF recognise us in different ways. And we are led by a board of trustees who act in the public interest, which is our remit. That includes ex-finance ministers, so we have one from the UK, Lord Alistair Darling, we have one from Singapore that's just joining, ex-SEC commissioners, we have a senator, we have a World Bank leader, and global private sector leaders. And they very much help us as an organisation in terms of good governance strategy and helping embed the importance of the valuation profession with different regulators that we work with around the world. And we do work with the leaders of the SEC, the leaders of the PCAOB, the leaders of IOSCO, which brings together the world grouping of valuers. So it's really important from a credibility point of view. What I'd really like to see at some point in the future is a very high status person from India join the board of trustees, because I think India as a key economy is fundamental. Indeed, when I look at India from a membership point of view, it's second only to the United States in terms of the number of members that we have from India. And it's great to see that sort of buy-in. We have 148 member organizations based around the world. The VPOs that we have involved with us, they qualify over 340,000 valuation professionals. And it's really important for us to work with the profession, with IOV and other organizations, with IBBI in helping establish the profession properly in India. Because if you don't have good professionalism, valuation standards mean nothing. This is an oversight of our board system. So we have the Standards Review Board, which oversees all technical standards and the general standards. Then it has the tangible assets, business valuation, and financial instruments. Intangibles is a growing area of importance. And it was touched on by one of the earlier speakers as to how valuation is changing. When we consider the importance of intangible assets, it's actually growing. If you look at the S&P 500, the financial statements actually only show 16% of the market capitalization because it tends to focus on tangible assets. And intangibles is becoming increasingly important. And there are other countries in Asia Pacific that are starting to put more and more focus on this. Which is worth more, Ford or Tesla? Ford is a massive car company. It produces 100 times more cars than Tesla. Yet Tesla is worth more because of the intangible assets. These are some examples of the Financial Instruments Board participants in both the working groups and financial instruments. This is a new area for us, which we have something on in our standards, but we are creating a much better evolution of the guidance that we currently have, with involvement from key regulators and stakeholders from around the world in order to do that. We're very pleased with the way this initiative is going, and you will see our first consultation out in around a month, and we would welcome comments from you on that. Examples of organisations that have adopted: Norges Bank, the biggest sovereign wealth fund in the world, has adopted IVS. Global data provider MSCI has adopted IVS. Hong Kong Institute of Surveyors has adopted IVS in terms of the valuers that actually use that. We're obviously in this moment of crisis right now, and I've just realised that my slides haven't actually. Never mind. I'll make them available afterwards. It's technological issue from my. Essentially, we are all in this time of crisis from a global point of view. What started as a health crisis, which has literally affected every country around the world, is now something that is transitioning very much into an economic crisis. Something which will be on the same scale, if not worse, than the global financial crisis that we saw 10 years ago. And when I think about how we emerge out of this, and I think about the importance of different professions, for me, the valuation profession is right up there in terms of how we give confidence to investors in the future, whether they're domestic investors or international investors. The key thing that everyone wants at the moment is confidence. And you as valuers are probably one of the most important professions in the world in terms of giving that. And so we welcome the steps that are being taken in India from a conceptual level in terms of creating a profession, a regulated profession. And if you're a good professional, you have nothing to worry about in relation to that. This is about establishing high quality valuations that will give confidence to investors, whether they're domestic or international. With that, I'm going to cut off and I'm going to hand over to Alex, who hopefully will have his slides working.
I'm going to give it a go. Please let me know if they don't work, but I'm just trying to put them up here. Can everyone see the slides at the moment?
Yeah, that works, Alex.
Brilliant. So I'm just going to talk you through the international valuation standards, and at the same time I will pick up the question that people have posted in relation to the reports and valuation reports and pro formas. So just starting off on the beginning, the latest edition of IVS became effective on the 31st of January 2020. It includes some new chapters. IVS 220 on financial liabilities, non-financial liabilities. Valuation models are now defined in the general standards, and there is a section on that. The glossary has been updated. In terms of development property, which is quite an important field, there is now a requirement to give an as-is value in addition to an as-proposed value. And then further clarity on limitations resulting in a non-IVS compliant valuation. Just very quickly, and not wanting to teach you things that you all know already, but you can see here some of the specialisms among tangible assets. They include personal property, art and antiques, plant and machinery, development property, biological assets, land, and of course real estate. Under business valuation, you can see some of the elements here. you may have noted the two recent papers that IVSC published on goodwill perspectives papers that were very well received, and the third paper is due to be published in the next week, I believe. Obviously, this includes businesses, inventories, intellectual properties, etc. And then we have financial instruments, who is our latest board, who've been working very hard over the past year or two, and you can see many of the topics that they deal with: derivatives, loans, bonds, fixed income instruments, etc. And I will happily make these slides available to everyone as well. So the IVS include common valuation principles and asset-specific standards. So the common valuation principles are in all the initial chapters, the general standards that I'll go through, IVS 101 to 105, which deal with everything from the client's initial instruction until you submit your final valuation report. And then we have asset-specific standards that go on from that. So it's quite a concise document. We purposely made it quite concise, and it is available for free. So first of all, looking at the structure, the IVS consists of mandatory requirements that must be followed in order to state that a valuation was performed in compliance with IVS. Certain aspects of the standards do not direct or mandate any particular course of action, but provide fundamental principles and concepts that must be considered in the valuation process. So the standards basically arranged into a framework, general standards, and asset standards. And you can see here generally the structure of the current edition of IVS. We have a glossary, and the glossary defines certain terms used in the international valuation standards. We haven't tried to define the terms for everyone. In fact, one of the hardest terms for us to define were, to be honest, value and valuation, particularly as value can sometimes be a cost and it can sometimes be a price. And we will be looking at that, dealing with it in future editions, and the board are currently looking at that issue. Now, you can see that there's a certain hierarchy of terms here used throughout the standards. The hierarchy basically must, which is an unconditional responsibility, should, which is presumptively mandatory, and may, which you must at least consider. So it does a hierarchy through the standard, telling you which bits you have to consider and which bits must be included no matter what. In addition, we published, we have a glossary. It includes a number of terms. You can see the definition of a valuer here. A valuer is an individual, group of individuals, or a firm who possess the necessary qualifications, ability, and experience to execute a valuation in an objective, unbiased, and competent manner. In some jurisdictions, licensing is required before one can act as a valuer. Now, you'll also notice that when we refer to the term asset, we're also referring to liabilities. We're also referring to a group of assets and a group of our liabilities, or a mix of both. A lot of people in the past have asked me what the difference is between an asset and a liability, and my apologies to Nick, who has heard this so many times, but it depends very much on your perspective. I see myself as an asset. My wife, she sees me as a liability. So there you can see how one term can have very different meanings in different markets. The IVS framework deals with certain aspects. Some of the assets are compliance with standards. If you make a statement that a valuation has been or will be prepared or undertaken in accordance with IVS, it's implicit that the valuation has been prepared with compliance with all relevant standards in IVS. Now, there is an exception, departures, that I'll go through in a minute. We expect all valuers to be objective, and obviously they have to be competent. That doesn't mean in some instructions I may not get a subcontractor to help me with elements of it. For example, if I was dealing with a factory, I may bring in a subcontractor to help me with the plant and machinery aspects. So departure is very important. It's a circumstance where specific legislative, regulatory, or other authoritative requirements must be followed that differ from some of the requirements within IVS. Departures are mandatory in that a valuer must comply with the legal, regulatory, and other authoritative requirements appropriate to the purpose and jurisdiction of the valuation to be in compliance with IVS. So if I do have a departure, I would just have to state the relevant law or statute that makes that departure mandatory for me, but my valuation would still be IVS compliant within those circumstances. So starting off, we've got the general standards, and the general standards relate to all our specialisms. So whether you're in business valuation, tangible assets, financial instruments, you all have to follow IVS 101 to 105, and it gives you everything from your initial instruction until you issue the final report. And continuing with Nick's football analogy, I don't know if IVSC is just obsessed on football, probably not, because my team's a bit rubbish at it, but separate from that is it tells you the rules, it doesn't tell you how to value. We are all highly trained valuers. We've been through university and everything else and professional qualifications to be valuers. It is not a textbook on how to value. It is the international standards under which you should value. And just moving forward and looking first of all as the scope of work. Scope of work in many markets is also called a terms of engagement, and it describes the fundamental terms of the valuation engagement, such as the assets being valued, the purpose of the valuation, and the responsibilities of the parties. And this standard applies to a wide range. So I just want to make it clear that it applies to in-house valuations. So if you were a valuer working for a development company or for your own employers, you would still have to comply with IVS. It deals with third-party valuations, so for clients, banks, secured lendings, etc. And it also deals with valuation reviewers. And in some instances, you may be just reviewing the assumptions used within a valuation and saying that in your mind they're reasonable. It doesn't mean that you're necessarily doing an entire new valuation when you're reviewing it. IVS 102 looks at investigations and compliance, and it says to be compliant with IVS, valuation assignments, including valuation reviews, must be conducted in accordance with all the principles set out in IVS that are appropriate for the purpose and the terms and conditions set out in the scope of work. And definitely when we're dealing in the times such as the times of the coronavirus, where there may be issues that come several years later, it is your scope of, or your investigation and your scope of work are two of the things that can save you, because they're the bits that say what you have agreed to do and what you're doing. And they would be the bits that are very much referred to. Now, IVS 103 deals with valuation reporting, and it says here, it's essential that the valuation report communicates the information necessary for proper understanding of the valuation or valuation review. A report must provide the intended users with a clear understanding of the valuation. For certain asset classes, there may be variations from these standards or additional requirements to be reported on. Now, I would like to pause here. I'm actually going to book now. I don't know if you can see it because this white screen does wonderful things. But we've had some questions with here in relation to a valuation report, and these are not new situations. We have the same situation in the UK where a bank may require specific reports to be used. So first of all, I'd like to read you 20.2. Compliance with this standard does not require a particular form or format of report. However, the report must be sufficient to communicate the intended users, the scope of the valuation assignment, the work performed, and the conclusions reached. And I would also like to highlight section 30. It says, where the report is the result of an assignment involving the valuation of an asset or assets, the report must convey the following at the minimum: the scope of work performed, the intended use, the approach or approaches adopted, the method or methods applied, the key inputs used, the assumptions made, the conclusions of value and principal reasons for any conclusions, and the date of the report. However, going back to your pro forma question, in 30.2, it specifically says some of the requirements may be explicitly included in a report or incorporated into a report through reference or other documents, engagement letters, scope of work documents, internal policies and procedures. So if you have a very specific pro forma that you have to use and some aspects are missing, providing those aspects are in your file and there is reference to your file, it would still be IVS compliant. I just want to state that this is not a new situation. It's a situation that we have in a lot of different markets. Now, the question also related to basis of value. So I'm going to have a look at basis of value here. Compliance with this mandatory standard requires a valuer to select the appropriate basis or bases of value and follow all applicable requirements associated with that basis of value, whether those requirements are included as part of this standard for IVS defined basis of value or not. So if you have another basis of value that you have to use, that's not an issue. It's still compliant with IVS. You should probably refer to that basis of value. It's quite good practice to include a definition of it within your report, and you should follow those requirements. So it's critical the basis of value must be appropriate to the terms and purpose of the valuation assignment, as a basis of value may influence or dictate a valuer's selection of methods, inputs, and assumptions, and the ultimate opinion of valuer. So if I was doing IFRS 13 fair value, that is the correct basis to use. I don't use market value. I have to use the correct basis of value for my instruction. And you may be required to use basis of value that are defined by statute, regulation, private contract, or other documents. And you should interpret them and apply them correctly. So the key concept is the valuers must choose the relevant basis of value according to the terms and purpose of the valuation. You should consider constructions and input received from the client and its representatives. However, at the end of the day, we are the professionals, so regardless of the instructions and input provided to the valuer should not use a basis or basis of value that is inappropriate for the intended purpose of valuation. And the example there is with IFRS and using fair value under that. So you can use basis of value that are outside IVS. And you can see here a list of them. We've given you a few examples. It's not an exhaustive list because it could just go on and on. You can see the main IVS basis of value, market rent, equitable value, investment value, synergistic value, which many of you may have previously known as marriage value, and liquidation value, i.e. values in relation to for sales. Now, we've shown some examples here because sometimes when people ask for fair value, they don't realize there's multiple definitions of fair value. So it is a reasonable question to ask them which one. So what we've done is we've got a few examples within the standard. They are not exhaustive. Now, valuation approaches, and I know that the question also applied to whether you should use more than one approach because some pro formas state only one approach. So there's several ways around this. You don't have to use more than one approach if, for example, you've got very liquid residential sales, a lot of recent comparables, and the market approach is sufficient. But it's advantageous to use other approaches. And if you're using a pro forma that only allows you to put in one approach, you can always put reference to the other approaches in your file. Because often we look at the approaches as like a toolbox within our belt to come up with the right answer. Now, here is the key concept again. Valuers are not required to use more than one method for the valuation of an asset, particularly when the valuer has a high degree of confidence in the accuracy and reliability of a single method given the facts and circumstances of the valuation engagement. However, you should consider the use of multiple approaches and methods, and more than one valuation approach or method may be used to arrive at an indication of value, particularly when there are insufficient factual or observable inputs for a single method to produce a reliable conclusion. In the UK at the moment, and I could pick any market in Europe, due to the coronavirus crisis, there's not been a lot of transactions happening. There is not a lot of market evidence. Valuers are having to look at other things, data, indices, sentiments. Hopefully you all saw the IVSC statement on valuation under uncertainty. So this is probably a time when you may want to look at more than one approach just to be sure of your valuation. And when more than one approach and method is used, or even multiple methods within a single approach, the conclusion of value based on these multiple approaches should be reasonable, and the process of analyzing and reconciling the different values into a single conclusion without averaging should be described by the valuer in the report. I've had situations in the past in markets in the Middle East where governments have told me they had two values, one at 10 million, one at 90 million for the same property. And I said, what did you do? And they said, we added them together and divided them by 2. Now, this is definitely the wrong answer, assuming one of those valuations were right. But there is extensive information on weighting and other bits within the standards. You can also see here the latest section that's been incorporated in IVS on valuation models. This will be followed by a subsequent question or section on data handling and data control. The chair very expertly mentioned AVMs earlier. This is a topic that is being reviewed by the IVS at the moment. One of the difficulties is, what is the difference between a calculation and a valuation? And we have to look at that, and we have to explore those definitions. Calculations are used in many models, and we'd be very happy to use IOV for fatal flaw reviews as we come out with draft changes to the standards. But we're definitely looking and considering those topics at the moment, and we're looking at the degree that the valuer has input in relation to the model. And we will be coming out with further standards in relation to that. The next main standards, and I'm just checking my watch because I know I can talk for hours and hours. I'm going to get Nick to wave his hand if I'm going on too long, and I'll round it up. But I really can talk a long time on these topics. But we're looking at the asset standards here, and you can see you've got IVS 200 on business and business interests, IVS 210 on intangible assets, and IVS 220 on non-financial instruments. So if I was doing a business valuation, I would refer to IVS 101 to 105, which are the general standards that apply to everything. And then I would look at the specific standards in relation to my instructions. Most business valuations would involve intangibles as well. So at the very least, I'll be looking at 200 and 210. And just moving forward a little bit here, the introduction, the definition of what constitutes a business may differ depending on the purpose of evaluation. However, generally a business conducts a commercial, industrial service, or investment activity Businesses can take many forms, such as corporations, partnerships, joint ventures, and sole proprietorships. The value of a business may differ from the sum of the values of the individual assets or liabilities. In fact, we've got many challenges on this recently in the UK, particularly in current times, where they're saying our assets are valued at this, but actually our company is valued at this. Well, they're very different valuations. Valuing a business takes into all sorts of things that you may not be accounting for when you're just looking at the value of the actual assets or liabilities that you hold. You can see here IVS 210, and all I've done is I've just given you the introduction because I'm trying to respect the time that we have here. But also I don't want to enjoy the surprise, because I'm sure many of you after this presentation are going to have a full read of international valuation standards. So you'll be able to have a look at them and get more detail, or to contact myself. You can see here that there's many types of tangible assets, but they are often considered to fall into one or more of the following categories or goodwill. And we've got here some examples here: marketing related, customer related, artistic related, contract related, and technology related. You can see here 220, it's the new chapter on financial liabilities. I'm trying to keep a good eye on time, so I won't go into detail on that one at the moment. Plant and equipment. Now, that is also known in the States and other parts as personal property. They use that under the fair value regulations, refer to it as personal property, but it's plant and equipment that we use. And they're tangible assets that are normally held by an entity for use in the manufacturing, production or supply or goods or services, for rental by others, or for administrative purposes, and that are expected to be used over a period of time. The right to use an item of plant and equipment, such as the right arising from a lease, would also follow the requirements of this standard. It must also be noted that the right to use an asset could have a different lifespan than the life of the underlying plant and equipment itself, and in such circumstances, the useful, economic, or effective lifespan must be stated. Now, we're over to real property interest, tangible assets. We are going to be doing revisions to this, which does partly relate to some of the slum properties as well that you were referring to in the initial presentation. We are looking at the moment to expand this to include unregistered land and other types of unregistered assets. So it would also relate to that and relate to more informal land settlements that are traded within the market, but maybe are not as formally registered. But at the moment, we show three main types of interest. The superior interest in any defined area of land. The owner of this interest has an absolute right of possession and control of the land and any buildings upon it in perpetuity, subject only to subordinate interests and any statutory or other legally enforceable constraints. I don't know if you use the same terms, you probably do. We would refer to this as freehold. The next one, a subordinate interest that normally gives the holder rights of exclusive possession and control of a defined area of land or buildings for a defined period under the terms of the lease or contract. We'd normally refer to that as leasehold. And a right to use lands or buildings, but without a right of exclusive possession or control, e.g. a right to pass over the land. We'd sort of look at that as licenses. But we now will also be including these sections a bit on unregistered land and less formal ownership to also bring them under the standards. And we'll be looking to review that and bring something on that. The next section, IVS 410, it deals with development property. And one of the issues that we noticed within the market with development properties is banks and other people would often lend on the gross development value, not realizing that at the moment they're looking at a patch of ground that may not even have full planning, and there's a lot of work before that GDV is reached. And therefore, the requirement now is to state the as is and as proposed value. We believe that that will deal with a number of issues and help secured lenders. And you can see here some examples: construction of buildings, previously undeveloped land, redevelopment of previously developed land, the improvement or alteration of existing buildings and structures, land allocated for development in a statutory plan, and land allocated for higher value uses or higher density in a statutory plan. And you can see here the section that I'm referring to. Actually, development property is one of the areas where we recommend that more than one approach is often used, because it's an area of high risk. There's a lot of assumptions that are being made that will relate to the development being completed. So to demonstrate an appreciation of the risks involved in valuing development property for secured lending or other purposes, the valuer should, now remember, should is presumptively mandatory, so if there's reasons why you don't have to follow that, just make sure you note it, should apply a minimum of 2 appropriate and recognized methods to valuing development property for each valuation project, as this is an area where there is often insufficient factual or observable inputs for a single method to produce a reliable conclusion. And you can see here also the requirement in relation to as is, i.e. the existing stage of development, and as proposed, the completed development value or gross development value. The final chapter that I'm going to talk to is IVS 500. This is currently being revised by the financial instruments boards, and there will be consultations going on this later this year. Obviously, this is a fast developing field, and we want to make sure that our standards keep in touch with this field. And you can see here some examples of financial instruments. It's not limited to these, but there's a few examples: acquisitions, mergers and sales of businesses or parts of businesses, purchase and sale, financial reporting, etc. So moving forward to some of the topics we're looking at over the next year, you can see here AVMs. I don't know if my mouse is showing over it, but it was mentioned. We are looking at that. We are looking at data and data handling. We are looking at further standards on public sector valuation, etc. Some of these dealt with, some of these are going to be dealt with. This year, you can see some of the publications we've given: exposure draft, 220 liabilities, additional technical revisions, and the latest version of IVS. We will be doing further technical revisions later this year, and we will also be publishing IVS 230 on inventories, post-consultation. We've also done some examples of different perspective papers we've got here. You can see one of the 3 in the goodwill range here. Is goodwill a wasting asset? We've also got one on biological assets, etc. We're looking to do more later this year, including one on revisions to market value and challenges, basically, to market value, to help people with that. So what I'm going to do, if I can work out how to do this now, is to stop sharing my document and to go back to you. And thank you very much for taking the time to listen to me. Both myself and Nick are happy to take any questions. If they're difficult questions, please pass them to Nick. If they're easy, I'll be very happy to deal with them. Thank you.
Request Nick to take some of the questions if you're comfortable and you have the still time to deal with.
Oh, I think some of these are fairly technical, so I will look to Alex on this. Hopefully everyone can hear me. In relation to
So the first question, Nick, is the one that I tried to respond when we referred to the report and pointed out that you didn't need a particular pro forma, etc., if that's right. So hopefully we've dealt with that one.
There's one, Alex, which talks about would like IVS to provide an explanatory handbook for IVS so that the individual will know the logic behind the clause as well as what is required from the individual valuer. What we actually do is we provide a basis for conclusions. This is something that's relatively new in terms of we've only done it for the last few years, so you won't necessarily find a record for what went before that. But essentially what it does is it explains the logic that the board went through in considering the public comments that they got and why they reached a particular conclusion. And that's available with each copy of the standards. So that might actually explain some of the questions that you have in relation to that. That's from Mr. Prabhu Desai. The other thing that we look for really in partnership with professional bodies is that they go into more depth and education around the standards and around how to interpret them in the local market. And so I would say that it's a combination of the two. I'll leave some of the others for Alex. There's one other. Is a disclaimer allowed in IVS? Sometimes there might be a conflict. So for example, you might have to comply with a local tax law in a country which conflicts with something in IVS. Now, where you have legislation which conflicts with IVS, the local legislation would always take priority. So I don't know whether that answers the question or not in this, but you would put a disclaimer in essentially saying you've done your valuation in accordance with IVS with an exception, which would in this instance would be in relation to that particular tax law, which you followed local legislation for. So the important thing here is about disclosure and transparency to your client. Someone's saying, please share the slides. I will send the slides across, mine and Alex's, across to Vinay. I'm conscious that mine didn't show, but hopefully you can have a look through those later. Will IVSC standards have to be legalized with tax laws in each country? Each country takes a different approach to tax law, not all quote specific standards. So some countries do enshrine IVS in legislation, along with any additional local guidance that they have. But in some countries, standards are what is the market norm. So what would banks typically ask for? What would customers typically ask for? If you looked at the UK, Australia, countries like that, it's not necessarily in law, but it's the expectation of what is followed. And that expectation is there with the VPOs. And the expectation is such that if you were to go to court in relation to this, then you would have to explain if you've used a different approach. But each country approaches its legislation differently. Alex, do you want to take some of the others on here?
I'll pick up the rest of them. Let me know if you've already dealt with them. So a question from a very nice name that I'm not going to try and pronounce. Many leading banks in India has mandated that the report should be IVS compliant, but they also insist on giving the report template. I think we've dealt with that. You can use a template. In some instances, you might want to keep more detailed notes within your file that you have reference to, but you can claim that you've followed IVS even when you're using non-defined basis of value. For example, if you're doing a fair value valuation, you're still following IVS. Nick is totally right. In the explanatory handbook, in the basis of conclusion, we try and explain the reasoning behind the board's decisions. The only other bit that I would add is, in terms of guidance, that's very much something that is done by the valuation professional organizations who are members of the IVSC Advisory Forum Working Group. They would each issue their own guidance to their members as to what it meant, just as you may want to do that yourselves as well. So it's not something that the IVS does, it's very much something that the IVS member organizations do. But in some instances, they might discuss and prepare common guidance. Now, is the employer-employee relationship possible for a valuer? If I try and move very quickly back to the slides, or if you refer to the slides later, because it doesn't seem to want to move backwards, obviously, yes, it is possible. In that situation, your employer is your client. Remember the slide that I went through where I said it applies to in-house valuations? That would be an example of that. Third-party valuations and also valuations reviews. A new law is being framed in India that body corporates are made eligible to act as a valuer, but as per IVS, valuers, individual groups of individuals or firms possessing the necessary qualifications. I'm not sure of the exact meaning of a body corporate here, but I would assume that the same principles apply, providing that body corporate has the necessary qualifications. It shouldn't be an issue, but if you want us to explore that further, we can. I'd need to understand more what you mean by that term, to be honest. Instead of a company partnership, LLP, only individual valuers are to be allowed for practice. I mean, I won't go into detail of that, but firms are made up of individual valuers, and when I submit a valuation report, it is my name that actually takes the valuation liability, because I would be submitting it as myself as the valuer. Can we have an IVS defined fair value in the near future? No, because we did that in the past and it caused a lot of market issues. I think if any of you remember previous versions, we had two definitions of fair value, one which was the IVS definition and the other was the IFRS definition. People found that this caused confusion in the market and then they didn't know what fair value to use. So we would say that when asked to do fair value, you should say to your client, which fair value do you want me to do it? And if it's for financial reporting purposes, it's IFRS 13. Funnily enough, the old definition of fair value is still in IVS. It's called equitable value because a few governments, including those in Brazil and Mexico, have adopted that value in their actual regulation. And the main difference with that definition is it allows you to include a special purchaser. So going back to the estate example, if the estate next door for me was for sale and I was willing to pay for it more because I wanted to build a massive hotel or something else, that would be included in my equitable value. It wouldn't be included in my market value. Is a disclaimer? Disclaimer, no. Departures, yes. In order to follow IVS, you have to follow the rules and the requirements of the government in which you're operating. What is the difference between a method and approach of valuation? It's a very good question. It's one the board was discussing about 2 days ago. The approaches are basically the overall umbrella in which the methods are contained. So you have the cost approach, the market approach, the income approach. Within there, you can have many methods that you use, you know, in order to get to that valuation. Is IVS coming out with detailed guidance in terms of investigations, inspections and investigations in view of COVID? As an international valuation standard setter, this would be very hard for us to do because every country has different government requirements and there are different stages of the COVID cycle. What I can say is many of the member organizations that I'm aware of, including API, RICS and others, have issued detailed guidance in terms of inspections and investigations in view of COVID. So if you're in that situation, have a look at member organizations. Can you explain biological assets? No, it's quite a complicated topic. I'll send you the paper on it. It's different types of assets that are being used nowadays and that have become very, very popular. It can be everything from farmland to medicines and onwards, and we will happily share that for you. Even after using IVS, if there is a difference in the values between two valuers, then how is it resolved? Well, art, valuation is an art and a science. We're never going to come to exactly the same number. We should be around the same figure. Obviously, it depends on how large the difference is, what the difference is, In the UK, we have third-party arbitration or mediation if there was a big difference between the figures being reported, but that is more of a legal and a valuation matter, and the main thing is to show that you've followed all the best processes. Nick dealt with the situation in relation to tax laws. Please explain, in the UK, entity limit allowed to perform valuation. What are the rules for ownership? I can get you, I'm not going to try and answer that off my head. That's not my speciality, Mohit, but I can go ahead with that. I've just I believe that Nick has 1 or 2 points, so I think I've dealt with most of those questions, but as you can tell, I really enjoy talking, so I'd better go back to Nick.
Thanks, Alex. I just had a couple of points in relation to some of the questions that Alex was answering. When we talk about COVID-19 situation, one of the things that we have done as a board is put out a statement on COVID-19, which can be found on the IVSC website and on LinkedIn. And that does cover off what should be done in times of uncertainty. It draws on information that was put together after the last global financial crisis. The other thing that we have done, if you want more in-depth guidance, is there is a page, which the same page as that, in fact, draws together guidance from different organizations around the world and how they are dealing with COVID-19 in different countries, if you wish to have that. On the fair value point, is a very good question. Some of you may recall Sir David Tweedy, who was the chair from an IFRS point of view before becoming the chair of the IVSC. He's now retired, although he stays as a special advisor on my team, I'm pleased to say. The way that he used to explain the relationship, and we have a memorandum of understanding with the IASB and we regularly meet with them, the way that he described it is that when you look at IFRS, it talks about the what and when that is needed to be valued, but it doesn't go into in-depth detail. So when it comes to the how, actually that's where international valuation standards are needed, and that's where the guidance and education from the different professional VPOs is needed. And so that's essentially the way that I would describe the relationship between IFRS and IVSC. Alex, I'll hand back over to you in case there are any other questions that have come up.
Okay, I'll just pick up the last few. There's a question here from Sunil Kumar Pandey. In India, market approach is required as mandatory requirement by most of the clients. Evidence are not reliable. What would you say? Well, actually join the rest of the world in that at the moment. It's very hard. So the first thing I would say is you would need to look at another approach to valuation. You should also consider other matters such as data and indices. There's also a hierarchy of comparable evidence, and sometimes if no evidence is available, you may have to look at offers and bids within the market as well. But when you do that, you should take very much a stand back and look approach. I mean, that's part of the skill of the valuer, is analyzing that evidence. The next one, in India, 90% valuers are dealing with banks. Banks rarely give mandate or confirmation of charges, not much keen and interested in providing proper documents. I think if you follow the requirements of IVS, you'd be okay, because we've tried not to be too prescriptive in terms of what is required within a report. So we haven't done a list, though there is a list available in the scope of work. But as much as you can, you should try and confirm your instruction with the bank, because obviously that's your protection, and check that you've done the right thing. Market approach, a valuer is required to give reference of comparable sales instances of the similar property in the nearby locality. If you don't find any sales instances, or the sales instances are verbal, there is a hierarchy of comparables. Therefore, you will decide how much weight to give that evidence, and you might even look from the perspective of historic sales. You might look at datas, indices, and other reports. Can a guideline value be considered as a base of value? I don't know. I don't have the experience on what a guideline value is. You'd have to send me the information to give you a more detailed answer. I'm sure many of the colleagues on this call would be able to help you with that as well, as they would be more familiar with that and also have familiarity with IVS. Evidence is always hard. We've got to try and look at other ways of looking at it when you can't get evidence. So obviously there's sentiment, there's offers, there's other valuation approaches that can be considered, and you've just got to try and give the best answer that you can, because at the end of the day, if we're not the people to do it, who is? So we've just got to work on what information is there. I'm going to stop there because I think we're very near to 1 o'clock, and I know that Nick and me have another call as well. So pause and thank you very much. Dhanyavad, shukriya, thank you.
Thank you very much, Alex and Nick, and you have explained the valuation in very detail. I would say that such a vast subject, even valuation standards, I know because we are holding our valuation standards training program through our organization, and we have already conducted 6 such programs, and it takes 2 days, where Alex has just explained with the slide within half an hour or so, and it was quite good explanation. And you have taken up all the questions. I would say that those are particularly pertaining to Indian conditions as well. But your view on our aspirations, I think our members' aspirations were much required, because when we say that we are to be regulated and developed in the sense to participate in competitively with the global practices, it is very much required. And going ahead, I would always like to have your participation in our programs, which Nick and I have discussed also. And I think more such programs will clarify more people if they get involved. And we are doing our valuation standards training program and other webinars as well, as I discussed with Nick also. And this is going to take some time. But now at least we have the questions, and I am happy that these questions are arising, and these are very vital at this stage, so that we know how we have to go about our future programs. I am having some glimpses that what our future programs should target. You also as our partner in the programs in future. So really nice to hear your views. And of course, Dr. Shukla, he gave us a very good, groundwork as far as the authorities are concerned. What is their take? And our Dr. Gautam Sen Gupta, the initial, remarks regarding the valuation and how he explained the use of technology, education, everything, and how we can progress. And it is, of course, Nick, you would agree with me that valuation is still under the, it's in developing, and it is a very dynamic subject altogether. It cannot be static. That's what I am always saying, is it cannot be static. If it is static, then it is no valuation from my idea. Because
we welcome the opportunity to be involved in webinars like this, and I think the work that Dr. Shukla is doing, I think is very important, and the insight from like Dr. Sengupta in establishing a real profession in India. And I think the opportunities are not just to help give confidence to inward investors, but it's also an opportunity for your members, both in terms of doing work for international companies, but also helping their international relevance if they choose to go and work overseas. And so having an approach which is both international, but provides you with the skill sets and local knowledge that is also needed in India, I think is absolutely the right combination. And so I think the efforts that you as an institution are making along with IBBI, I think are very good from an India and a global perspective.
Yeah, then I would like to inform here that as an RVO, or the VPO you can say, when we adopted international valuation standards according to the rules of the company rules, at the same time we formed a valuation standard board in our this organization, which is now chaired by Mr. Subramaniam Pichaiya ji. And under this thing, we are even formulating the guidance notes of our own. And for that matter, we would always like to take your help also to formalize and to prepare those guidance notes. And we have come up with a very robust board, which consists of number of eminent valuers in all classes of assets, along with some legal support. So, and going ahead, as I earlier said, that we'll have to plan, seeing today's response and the question and answers, I think it is becomes, for you also, I think you would agree that you people are required to help us out and to develop and to make a level field playing for our Indian values at a global level. That's what I wanted to say. If you, anything, sir, Dr. Shukla, if you want to say a few words, just concluding this thing.
Yeah, actually, one of the question I thought, because we are getting the same questions all the time on the valuation bill on corporate body. So I tried to clarify at the end that this is a misnomer to say this is something new we are trying. So we have mentioned it, but the still question has come. So it was very much part of 2017 Valuer bill, Valuer standard. So regulations contain this provision. So nothing new, but so far we were able to withstand the pressure, and individuals were still flourishing despite provision being there. So I have no doubt that excellence will prevail over the semantics. So definitely they will do well in coming future as well. Thank you very much.
Thank you. Thank you, sir. Thank you, all of you. Dr. Saab, thank you. Our chairman, sir. Thank you very much for being here with us and giving me this required support in this endeavor. And we perhaps look forward for other many programs in coming months, because we have a lot to do. And the responsibility, I concede that the responsibility we'll have to share with the IBBI. Not only IBBI, it's for the fraternity, it's for the valuation profession in India and especially globally. And we would like to participate globally also in our endeavors. Thank you very much. Thank you very much for the partners.
Thank you.
Thank you. Thank you, sir.
Thank you.